Thank you very much, Chairwoman Wagner, for calling this timely hearing and for how we can improve our public markets to make them more attractive for both small and emerging companies. So I'd like to start by looking at the historical statistics of the last year, according to Ernst & Young. IPOs basically crawled to a halt in 2022. The number of deals in the U.S. fell roughly 78% from a year earlier. There were only 2 IPOs on the U.S. exchange that had more than $1 billion of proceeds, compared to 30 in 2021. Further, the number of IPOs with proceeds under $50 million represented roughly 80% of the U.S. IPO activity in 2022. So let's put this in a historical context. On average, over the last decade, approximately 80%, Madam Chair, of U.S. IPO has proceeds over $50 million. Now, I know that many factors can contribute to this, including significant regulatory costs associated with initial public offerings and ongoing reporting as a public company. Director Pivovar, I'd like to begin with you, sir. First, thank you very much for spending a very busy schedule with us here in the Financial Services Subcommittee on Capital Markets. I also read that you are a former assistant professor at Iowa State University.
That's right. Go Cyclones.
There we go, exactly. We'll see how Baylor does tonight, but thank you very much for coming in here and working with us. As you were also the leading economist on the Senate Banking Committee during the original Jobs Act, I'd like to ask you the following question. We just talked about the declining IPOs on numerous occasions today. With high interest rates and a likely recession potentially by the end of this year, and several new SEC regulations that will increase the cost to issuers, the downward trend in IPOs will likely continue. Could you share with us what a declining IPO means for everyday investors, including folks from the heartland like those in Iowa?
Sure. You mentioned, higher interest rates and higher inflation going forward. I mean, low interest rates is one of the reasons why the private markets were so competitive vis-a-vis the public markets for so long. Right. So if you think of, private equity firms investing in portfolio companies, a lot of times they use debt to finance those purchases. And so we're going to see that the private markets are probably going to become less competitive. And so that's why it's even more important that the public markets remain competitive. To your question about why the public markets are so important, Chairman Wagner had mentioned the fact that, this is the way that most everyday Americans actually save for their retirement, is investing in public companies. In the interest of comity, I was critical of, my fellow witness, Professor Bowser's views on one thing. I will say I agree with her that we need to revisit the accredited investor definition. Because so many Americans are locked out of investing in high-growth private companies and companies that are staying private longer, as Ms. Pinedo mentioned. And so everyday investors are basically locked in many ways to investing in the public capital markets. So that's why we need to do both. We need to make sure that investors have access, more equitable access to opportunities in the private market companies, but also we need to make sure that our public markets remain competitive so that the funds that are already invested there they can use to save for retirement and education.
Very poignant to this. So both as an economist, but also I think it's worth noting you were the former SEC commissioner. I want to talk about the pace of rulemaking coming out of the SEC. Yeah. Will the magnitude of these rules raise the cost in any way that makes our public markets less attractive for those interested in raising that capital?
Yes. I mean, the pace of rulemaking, when I was there, we had a high pace of rulemaking, but that was mandated rulemaking by Congress. We had the Dodd-Frank Act, and then we had the Jobs Act, and so those were mandated rules. If you look at what's going on at the Commission right now, it's unprecedented in terms of the number of rulemakings that are going through on a discretionary basis. And as I mentioned earlier, it's the accumulation of all the rules together, right? On any individual basis, you may say, well, the costs maybe are worth the benefits, but over time we know that it's the accumulation of those rules that could actually gum up the markets.
So with the SEC basically doing the legislation that has traditionally been done by Congress, let me ask this. Are there things that Congress needs to be doing now, either to rein in the SEC or to make this more effective or at least more attractive for our public markets?
Yeah, so one is, we mentioned the bills that are here that are amendments to the Jobs Act and how the Jobs Act actually helped the SEC refocus on the often third-party the often forgotten third part of its mission, right? So everybody remembers protecting investors, maintaining fair, orderly, and efficient markets. And over the past few years, we've had some instances. We had the pandemic and concerns about the markets running through that. We've had the meme stock trading in 2021 that really focused the SEC. The SEC focused on some of the market structure stuff. Similarly, because of Dodd-Frank, the SEC was mandated to do over 100 rulemakings, and so that returned them to the capital formation piece, and I think similarly amendments could do the same.
Powerful. Thank you, Mr. Pivovar. With that, I yield my time.